The last part of question 5D, the average was 35%, quite low. It actually presented some information that didn't really apply to the previous part, so it did give you a fresh start if you had trouble with parts A, B or C. So what we're told is in May 2015, GHK Supplies, which is us, traded in machinery on the cash purchase of new machinery which cost $52,000 plus GST. Now we got a trading allowance of $10,000. So what we're asked is complete the table provided to show how this transaction would be reported in the cash flow statement. So what's happened is we are GHK Supplies. We've got an old piece of machinery and we're going to trade it in for $10,000 to a supplier, and we're going to buy new machinery for $52,000 plus GST from them. So we'll do a trade there, and what will happen is we'll owe them, we're going to buy with cash, and how much will we pay? Well, we're going to buy a new asset for $52,000, but we'll take out the trade-in we're going to get for $10,000, which means we're going to pay $42,000 for the new machinery, plus the GST. Now the GST will be the full 10% of $52,000, so that's $5,200, and that means we're going to pay a total of $47,200. So that's the number we want to balance to. Whatever answer we write, we want to make sure we're only going to have total cash paid of $47,200. So looking at our question, we're asked to put this in a table for the cash flow statement. So to do that, we're going to need to remember the difference between the sections of the cash flow statement. So the first one is operating activities, cash flows from providing goods and services in the day-to-day operations of the business. Investing, cash flows from buying and selling non-current assets. And lastly, financing, cash flows from changes in the firm's financial structure. So what cash flows do we have here? We've basically got two. We've got paying $42,000 for the asset and $5,200 for GST. So what we need to do is place those two cash flows in these sections of the cash flow statement. So let's take the $42,000 paid for the new asset. Well, that is actually an investing activity. We are buying a new non-current asset. It's actually a $52,000 asset, but we're only going to pay $42,000. So $42,000 should go in as an investing activity outflow. The GST, that's where it gets a little bit tricky. Just because the asset we're buying is non-current doesn't mean the GST paid is actually an investing activity. That's still and always will be an operating activity. Any GST payment always goes in the operating section. So once we figure that out, we can now fill in our table. So we've got operating activities. We think there'll be GST paid, which will be an outflow of $5,200. Investing activities, we'll buy machinery, which will be an outflow for $42,000. And lastly, that'll leave financing activities. There'll be no item recorded, no effect, and the amount will be 0. Looking at the marks for this question, there were 2 marks, one for correctly getting the operating activity part right and one for the investing, and no mark was awarded for financing, which means no mark was taken off if it was incorrect as well. Looking at the mark breakdown, 52% of students had trouble. I imagine a lot of that would have been to do with the difficulty of questions 5A, B and C. People might have thought, well, 5D related to that information and they just moved on. And 18% of students got the full 2 marks. The average was 0.7, and the examiner's comments were, despite the business buying the machinery, some students thought there was an inflow of cash instead of an outflow. So that trade-in allowance, remember, is not actually us getting money, it's just getting saving money in terms of how much we're going to spend. And the trade-in allowance does not involve a flow of cash. So the same point, we're talking about not getting $10,000, we're just talking about spending less money.